Last month, I stumbled upon some really interesting relationships that I believe to be telling us something important about the equity market. And the first relationship is between CoCo bonds and equities, so contingent convertible debt and stocks. And I want to just go ahead and put up a chart and show what I discovered, and then we'll discuss what I think is going on here and how we can potentially use it for forecasting. So what I'm plotting here is an index of CoCo bonds. It's the Bloomberg Barclays European Banks Tier 1 index. It doesn't look like much until we add a few arrows. And these arrows show various turning points in the German DAX index. And suddenly this pattern really jumps out, right? Upward reversals in the CoCo index, they tend to coincide with major peaks in the DAX. Downward reversals attend major bottoms. Okay, so what's really going on here? Well, remember that CoCo bonds are this extremely risky form of bank debt, right? The bonds essentially convert into equity when a bank gets into trouble. So from the perspective of investor psychology, the CoCo market is extremely sensitive to changes in social mood, right? That makes sense. If a bank gets into trouble, your CoCo bonds suddenly become equity, and that equity is very likely worthless in the event of a bankruptcy. So when stocks are falling, CoCo yields tend to rise as investors sell the bonds under the belief that banks will get into trouble. And then trends toward optimism, alternatively, send investors into the CoCo market, right? Investors get complacent, they chase the higher yields that CoCos offers. So it's kind of an exaggerated form of junk bonds. The junk bond indexes behave similarly, but what I didn't realize until now was just how closely this particular index tracks equities. Again, those arrows label turns in the DAX index, but the DAX turns more or less in line with other major equity indexes. So the CoCo market is definitely something that every investor should keep an eye on. And especially right now, because you can see that we are back in the range that has signaled previous stock market peaks. Okay, the other chart I want to show is a concept called excess liquidity. This is money that is available to Eurozone banks that exceeds their actual requirements. And the concept is a little confusing, but what it boils down to is that before the '08 financial crisis, banks competed for interbank funds. After the crisis, ECB goes to this full allotment system and ended that competition. That's the history, but this is important because in addition to kind of warping the incentives that markets provide, what really stands out to a wave analyst is the pattern that has emerged in excess liquidity since the financial crisis. And you can see that pattern here. This is just a crystal clear 5-wave move. You've got the initial run up in wave 1, the setback in wave 2, you've got that long third wave. You even have alternation between waves 2 and 4, a sharp correction versus a sideways correction. So this is compelling because whatever this metric is measuring, right? This could be cattle futures, it could be hourly wages for window washers, who knows? Whatever this measures, it is traced out 5 waves up. It has also tracked a 5-wave pattern in equities since the crisis, and it is very likely ending, right? That's what a 5-wave move tells us to expect a correction. So this is another metric that everyone should be watching very closely, especially because we are overdue now for the next correction in equities.